And a pleasant Monday afternoon to everyone out there. Greg Sher, another edition of One on One, and a man I've been chasing for months is joining me now, Andy Davidson. He's the president at Andrew Davidson and Company, someone that is well versed on all things the financial markets, secondary market, the credit market. In fact, he just produced a paper on single pool versus tri-merge and what that might yield. But before we get to that, a very, very, very happy hello to you, Andy. How are you?
I'm great. Yeah, thanks for having me on. It's great to talk to you. I'm not that hard to find, so but
I
I'm
found
glad
you.
we can line up our schedules.
I found you, but you passed pending the release of your paper. Do we call it a white paper, or what do we call it?
Yeah, white paper is fine.
Okay. Well, why don't we, before we jump into that, just give me a little bit of framing around your experience in the secondary market. How well do you know mortgages, and how well do you know all of the links in the chain?
You know, I've been doing mortgages now for many, many decades. I started Merrill Lynch in 1985 in their mortgage research department. And as part of that, I worked very closely with the traders on the trading desk and helped develop many of the models that were used by them. I was, for some time, the risk manager on the Merrill Lynch mortgage desk. And I started my own company in 1992. So that's also been a couple of decades. We provide prepayment models and credit models to financial institutions involved in mortgages. A couple of hundred firms use our models directly, and a couple of thousand more use it indirectly. And then, we're in touch with many of them. We provide consulting advice to people throughout the chain. So one of the things that's sort of unique about us in the mortgage market is that we're involved from people from the very beginning, from the origination end, all the way through the investing end, and even the regulators of the investors are clients of ours. So soup to nuts, I guess.
Yeah, well, the reason I reached out to you is because I was doing my own analysis, along with many people in the mortgage industry, kind of scrambling to understand if whatever position we have, and I'm against a single pool, by the way, but some are for it, just trying to discover data behind it, right? Because not every opinion has data behind it. There are a lot of people that just have a feeling, or that will just say, you know what, why not try this to try and break up the monopoly and drive more competition. And so I sought you out because of your understanding of the secondary market. And I came to the conclusion, although no data behind this is what I was driving towards, is that the secondary market will have less of an appetite for a product that they don't have any predictability around, right? That's what numbers is all about. Data is all about. Like, even though FICO is an inferior model, you could argue it's not the 10T. It's been in its current state for many, many years. At least it's the devil that they know. So they know the premium, they know the prepays, they know what to expect. And here, looking at a scenario where we may go to a single pool, they're going to know a lot less, which led to me to go search for someone like you to say, is that thinking right? That should we go to a single pool, that the pay up for these loans will be less because the risk will be greater and more of an unknown?
Yeah, that's absolutely right, at least in the short term, right? So that investors like to invest in things they know, things they don't know, they're willing to look at, but they almost always react by having what they call a wider spread or a lower price, right? And so the best way to react to uncertainty is say, yep, that might be right, but it might be wrong. How much could it be wrong? And I want to protect myself. So anything that's changing is going to generally lead to lower prices, at least in the short term. Now, if it turns out it's better information, then in the long term, it could produce higher prices. In this situation, it's just unlikely to see how one poll or, data from one bureau is going to be better than the current tri-merge, right? So the question is, how much worse is it? Not, is it better?
Well, then why are certain trade groups, why are certain people in the industry pushing so hard? Is it just that feeling like, hey, we've tried everything else, let's try this? Is that the sense you get, or is there really data behind what they're trying to do?
Yeah, I would say that, the motivation is that, profits in the mortgage market have been pretty tough the last few years. And credit costs are like a decent expense item or a line item that shows up in originating a mortgage. And people saying like, how can we reduce those costs? And, so they would like to reduce the cost. The problem is that the person spending the money isn't the person who's benefiting from it being spent. Right. So the originator, they don't use the credit score except to make sure the borrower can qualify. Fannie and Freddie have their own models that determine whether or not they want to guarantee a loan. And so the impact of the credit score is on the investor. And so the investor isn't the one buying the credit score, deciding whether or not it's worth the price. They're just saying, hey, you give us information, you give us good information, we'll pay more. You give us poor quality information, we'll pay less.
Well, let's dive into your white paper. Okay, so you released this just a couple of weeks ago, the impact of moving away from the tri-merge standard. And, there are a lot of findings in here, and there's a lot of charts, but, among the things that you learned, 35% of consumers have at least one credit score that differs by 10 points or more, depending on bureaus used. 18% of consumers have at least one score that differs by 20 points or more. 7% of consumers have at least one score that differs by 40 points or more. And a 20-point score difference guarantees movement in a different LLPA pricing bucket. Where do you want to go with this data set?
Yeah, so let's. So I think the first point is that this is actually real data. So just like you're saying, you're looking around for data. Like there's been a lot of discussion of tri-merge, bi-merge, single pull. But a lot of it was anecdotal or people who just had their own data they were working with. And so this study, which was commissioned by the credit bureaus, actually has the data on all the consumers. And it's data that just didn't really exist before. We had actually started this study with the bureaus a couple of years ago when the bi-merge was under discussion. And we said, it would be really great to have data to discuss this, not just people say, yeah, it's good or it's bad. And so over time, we got all three bureaus on board with providing us data where we actually have the credit score from three different borrowers. So I should mention that we did the study with the Vantage score, not with the FICO score. We've talked a little bit about some advantages or disadvantages. But one other data point I want to point out, which I think is really interesting, is that when we look at these scores, 28% of the borrowers have the same exact Vantage score from all three bureaus. So you think, oh, this is really good. Like more than a quarter of the people have no difference in credit score. But also, more than 1% have scores that differ by 100. So the numbers that you mentioned are sort of the ones in between that. And it's just sort of numbers that like people aren't really used to dealing with distributions that look like this, where it looks like in the middle, it has a low standard deviation or low variance, but on the extremes, it's varying a lot. And, so that's really what creates the issue here. It's not what's going on in the middle where the scores are similar. It's just how different scores can be on the extremes.
Was it complicated to do this study?
It's just a lot of data. So, once you have three numbers, if we only had 100 borrowers, you could do it on your PC, in 15 minutes. But, we're dealing with a couple 100 million borrowers. So it's a lot of data to handle.
So you used Vantage score, as you mentioned, as opposed to using FICO. So if a detractor from the outside looking in said, well, that's not the same as FICO, and when we're looking at 1 versus 3, that's the score we're looking at, what would you say to that?
So we'd be happy to do an analysis with FICO. We'd have to get FICO to agree to help provide that data. But there's sort of advantage and disadvantage of using the Vantage score. So the advantage is the one, just mentioned, that we have a large percentage that have the exact same score. And that's because the Vantage score model is the same across all three bureaus, and it's computed in the same way. The FICO score actually has different computation at each bureau. There's slightly different models and slightly different mode of calculation. So you're going to see some differences in FICO score that differ because of the model. In this case, all of the differences are because of different data at the different bureaus. So even if the score differences aren't going to be exactly the same, this is still very reflective of data differences between the three bureaus.
Let's open up the curtain and ask you the question. What did you conclude? What does this white paper tell us about one score versus three?
Yeah, I mean, the main thing it says is that if you switch from a bi-merge and a tri-merge and use the median, and then you switch to one score, that there's going to be more variance in score. And there's sort of like two aspects to that. One is if you just randomly picked one bureau and we had to use that same bureau for everyone, that would just create a little less certainty, and the results would be a little less reliable. Some borrowers would get charged a little more than they should, some a little less. Investors would be a little less able to rely on these scores to measure the risk because there's just a greater variance in the outcome that's coming from randomness rather than from the actual borrower characteristics. This really compounds itself once you start to say, well, can someone choose which score to use? And when someone can choose among which score to use, we can assume that the system, however it ends up working, is going to start choosing the score that lowers the cost to the borrower or lowers the cost to the originator. And that's going to start leading to bias in the scores, right? So scores would start to be higher and higher. So the loan level price adjustments would be lower, that the loans would look better from a credit perspective when you start to sell them to investors. So that seems like, oh, that would be a positive until the market decides to react to that.
Well, until the data comes in and loans start to default at a higher clip. And is that what would happen in your opinion?
Exactly. So what would seem is like what used to be a 720 default rate would now be like a 740 default rate, or maybe a 760 default rate, right? Because everyone would want to start reporting their highest score, right? So let's say you were going to take out a loan, and you can go online and see what your credit scores are. And you go to, a mortgage originator, and they say, we're going to give you this loan. You have a 720 score. And you say, well, I have a 760 from blah, blah bureau. They say like, well, that's not the one we pulled. You say, okay, thanks. And you go call up the next guy, and you get this. You find the guy who will do the 760. So
the gamification aspect is not avoidable. I mean, despite the fact that the MBA says, well, part of this would have to be that you prove you let everybody know which credit bureaus you pulled and have to produce all scores. I mean, that is really pie in the sky when every consumer can go onto Credit Karma or freecreditreport.com, and for a very small price, they can see all three scores. I mean, your scenario to me is more complicated. I just to see if my thesis was right, I went and got my credit score for $29 in a matter of seconds. I got all three. It took me no time. I didn't involve a lender. And what that did is it put me in position to be able to call up the lender and say, hey, can you pull my Experian? That's my highest score. I want to do a mortgage.
That's right. So one way or the other, if the data exists, it's going to be used, right? Like there's really no way around that.
Andy, so there's like these, it's very complex, the ripple effects here. We've already talked about the secondary market, and I want you to quantify that for me too in a minute. We've talked about LLPAs a little bit. We'll dive deeper into that. But then there's also, and this is the part I want you to help me understand a little bit better. And it's been said, and I believe you said it in your paper, that it would lead, single pool would eventually lead to higher interest rates. Can you help me understand why that would be?
Yeah, so one of the things you're thinking is that, on average, which credit score we use doesn't affect the overall risk of the market, right? So the interest rates we were talking about, it was like the rate charged by the mortgage secondary market. So it could be offset by lower cost upfront. But from a secondary marketing standpoint, if there's more risk and less certainty, that generally leads to lower prices.
All right. So you're not talking about interest rates. Like I offered you 6.5% fixed before this, and now I'm offering you 7%. You're talking about the rates paid for the loans that are pooled.
Right. So
okay, good.
It's hard to say net where it comes out.
I understand. Well, that's a good distinction. Yeah, that's a good distinction because anyone like me, who didn't go to Harvard and didn't have a BA in math and physics as you do, would look at that and go, "Oh, rates are going up." Well, help me understand that. So now this is perfect. Let's go backwards into the impact that you cited that you believe will happen if we go to a single pool with the secondary market's appetite, less of an appetite. What can you qualify that for us? But give us an example of what you think it might look like on an X loan amount that they'd normally pay this for in dollars, and what you think that might look like, what the variance is, percentage-wise or numbers-wise.
Yeah, it's hard to give, quantify is more difficult. I can give you sort of a couple of examples where this affects things. So, in the broad TBA market, it's hard to say exactly what the effect would be. Just if there's general uncertainty, that could widen mortgage spreads a couple of basis points, and so a couple 30 seconds in price, which can add up, and maybe actually just as much as the savings that we're talking about, just from general uncertainty. But there's like two specific places where the impact is larger. So one is borrowers with low credit scores, basically FICO scores below 700. There's a thing called a pay-up. I don't know if you've talked to your audience about pay-ups before, but when people buy those pools in the market, the investors, they're willing to pay more for borrowers with low credit scores because they think they're less likely to prepay when rates fall. Once there's uncertainty about whether or not those borrowers could refinance using a different score or a different bureau, or it could change, or there's uncertainty, they're willing to pay less for those particular pools. So while that's been an advantage in your pricing when you had a low credit score, that advantage could go away. And there's already some evidence that people are starting to look at that market and be a little less certain about it, not so much because of the tri-merge, but because of the Vantage Score FICO discussion. The other place is that there's a pricing of the credit side of the mortgage as well. And that's either reflected in the loan level price adjustments charged by Fannie and Freddie, and also in the credit risk transfer market that Fannie and Freddie use to hedge or manage their credit risk. And once again, if you start to have credit scores that used to be 720 drifting up to 740, people not only make the adjustment for the expected change because of the gaming, but also an additional change because there's uncertainty of how the gaming is actually going to work out. Because it's one thing to do an analysis on, theoretical data or actual data, but not actually used. But seeing it how it actually flows through the system is what's important to the investors. They're not that they're interested in looking at the studies, but in the end, investors are going to look at the actual data that comes through, and until they actually have data, they're going to be more conservative. And so that also widens the spread and lowers the pricing. And given that we're talking about loans of a couple of $100,000, it doesn't take very much of a drop in price to create a couple of $100 difference in the overall execution on the mortgage.
You've given us a lot here. Did you arrive at a percentage? Should we go to a single pool between the two dynamics that you just explained, between the LLPAs, potentially, I guess, going up eventually, right? You'd have to expect that. And then also the diminished appetite around the uncertainty in the secondary market. How much more expensive could that make to manufacture a mortgage when the mortgage company is getting less for those loans?
Yeah, I don't think we can come up with an exact number yet. It's just
1%? Is it less? Is it more? Is it 1%? Is it?
I don't. So let's say like borrower rates now are like, they just went up again, 6.25%, 6.5%. I don't think we're talking about 7%. I think we're talking about on the order of basis point changes from 650 to 660 or 670. So less than a 1% change in the overall execution, probably less than a 0.5 point change in the overall.
But in aggregate, billions potentially.
Definitely. It's definitely in the aggregate could be billions, but let's say per loan we could definitely be talking about thousands of dollars.
Yeah. Let's pivot into Vantage Score.
Yep.
So what's taking so long? And those people pretty well. You obviously dove into a lot of their data. I would say what's taken so long, and maybe why don't we reverse these questions? What do you think of the integrity of the VantageScore data? Let's start there. That's more important than getting your opinion on what's taking so long. But I would like to hear that.
Okay, sure. The VantageScore looks like a solid model to us. It's different than the classic FICO score for a couple of reasons. One is that it includes some data that wasn't included in the classic FICO score. The other is that it includes trended data, and trended data means not just looking at payment history, but also looking at balance history, which could help you make better credit decisions. So it turns out that while a lot of that is very valuable to you if you're a lender, it's not clear yet if that's valuable to you if you're an investor who's being given those scores, right? So we don't think there's anything wrong with the VantageScore. It looks like a good model. But until it's being actually in use, just as we're talking about the tri-merge versus the single, till it's actually in use, it's very hard for the investment community to say, yes, that's improving my investment process.
How about the second part? Why do you think
why is it taking so long?
Yeah.
I think it's taking long because it's a complicated system where FICO Classic is heavily invested into the system. It's like a long-term basis, and a lot of things rely on it. And moving away from that is difficult. And then I think once you start getting into these choice aspects, you introduce adverse selection, and it creates a lot of concerns on people's part. And figure out how to address that is also difficult.
All right. So
I had one investor who said to me that, if tomorrow we switched entirely to VantageScore, it would be worse for a while. We'd get the data and we would just deal with it. But it's really like a transition and choice that are very difficult for the market.
Yeah. So something I've talked a lot about on my posts on LinkedIn is, what if the FHFA gave VantageScore an explicit guarantee, or gave loans that have VantageScores an explicit guarantee to protect everybody in the ecosystem for a period of time while we ramp and assess the data? At that point, there'd be no reason not to do it, especially if you thought that it would lead to a lower cost to the consumer.
Well, in the TBA market, there already is a guarantee, right? So if you're investing in MBS, there's already a full faith and credit guarantee.
I'm talking about a mortgage that's qualified just on VantageScore. Let's say tomorrow FHFA says, all right, not only are we taking VantageScore, but we're ready for it. All the mechanisms involved in receiving these loans are solid and ready to go. And we're giving an explicit guarantee for those mortgages that closed with just VantageScores for a period of time while we assess the data. In other words, they take the risk. It's not the secondary market. It's not the mortgage company anymore. They're saying we believe this is the right thing to do. And so we're going to step in as an intermediary.
Yeah, like I say, on the TBA market, they already do that. The problem is that for the TBA investors, so let's say these pay up for the low credit score, that's not a credit risk. That's a prepayment risk, right? And so to the extent there's any prepayment uncertainty created through this transition, the GSEs can't absorb that because they're selling MBS pools where the prepayment risk gets passed to the investor. On the credit risk side, yes, they could take on more of that. And, that's generally how markets like this work. So for example, if you want, like, let's say, a large bank wanted to switch to VantageScore entirely, they could say, we're going to do some deals. Either we'll hold it in our portfolio and show you the performance, or we can do a deal that gets rated, and we don't mind if the spread is wider on those couple of deals, because we believe in the long term this is going to be better for us and our consumers, so they can take the loss. So anyway, there definitely could be things of that sort. Like, let's say, certainly on the credit risk transfer, is they could say, we're not going to put VantageScore loans into credit risk transfer for some time, but that slows down the adoption. So it's hard to figure out exactly how to remove all of the risk.
Yeah.
That's an information risk as opposed to a quality, not just a quality risk, but also an information risk.
All right, so I have a question you are overqualified to answer here as a, having a BA from Harvard in math and physics. Should we even be looking at credit scores anymore? Are we just tethered to an old model? Should we be looking at other things? Should we break this out in a different way? This black box has been around, antiquated forever. I mean, should we start there? Should we start with a new beginning?
Once again, I'm not sure we want to throw out what we have, but it would be great to introduce some new things. And introducing like just another credit score isn't as far as we could go. We would certainly rather see some of the components and some of the new data that's being collected now that's not in credit score being made available to the investor community. So in addition to the credit score, it might be useful to have 4 or 5 additional pieces of information.
Well, let me reframe this.
Yes.
You are given the assignment of showing the agencies what an alternative could look like. You just said there are 4, 5, 6 things, 6 additional things that you would layer on top. Like if you were to rebuild how credit is looked at, and you certainly have the brain to do that, give us a window into what that might look like.
Yeah. So I think let's start with like what would we like the end result to be, right? And that will help us figure out how to get there.
Yeah. Low defaults, low payoffs. But you go ahead. Let me not speak for you.
Yeah. So like the credit score currently is basically designed to forecast whether or not someone will become delinquent over the next 12 to 24 months. But when someone's in a mortgage, what we really want to know is, can they continue to make those payments over the life of the loan, right? So there's other information that we'd like to have. So we have more debt to income ratio, which is great, which wasn't in the credit score and wasn't very available until recently. We have very little information on the assets that the borrower has. Like, so what was the source of down payment? Do they have other savings currently? So what's their resiliency? And then we also don't have very much information on if someone misses a payment, how likely are they to cure? Right? We've changed a lot of things about mortgages in the last few years where you now try and do loan modifications. And the question is like, what are the financial capacity of this individual to cure, even if they have a short-term disruption in their ability to pay, right? So we used to think, becoming delinquent meant you were definitely going to default. Now we think becoming delinquent is the start of a process where we're going to try and look for solutions. And so having metrics based on either the person's credit file or other financial information about that borrower, maybe some of the stuff that's in their bank account, sort of broadening the data set and splitting it up in a way that it answers the questions that we want to answer is the thought process that leads to that solution.
What's one thing that you believe deserves a heavier weight?
So certainly knowing how much cash reserves the person has after they've made their down payment, would be extremely important. Even with the new credit scores, with the trended data, we would actually rather see the trended data variable split out from the credit score. Like we would like to know, is this person a revolver or a transactor, rather than combine that in with the credit score. Just separating that information out could be very valuable.
So when you say you'd like to know how much excess cash they have, a lot of people are going to hear that and go, well, we already do that through the loan process. It's standard. We ask for what are you saying, get that, somehow collect that and factor that in as you're delivering a score? That would be a component?
It would be something that would go to the investors, right? So we have different people have access to different information along the way, right? So if you're originating the loan, you have what they call permissible purpose, and then you also have a loan application. So you can ask all sorts of questions. And then you can go to the credit file and see whatever information you want. When it gets to the investors only receive the information that's sent to them by someone else. They don't have any right to go ask the borrower any question or even go look at the credit file of that investor once it's in a mortgage security. And so they're dependent on the information provided to them, which currently is the credit score and the loan to value ratio, and in some, in more cases now, the debt to income ratio.
Got it. So my question to you, to make sure that that you understood it the way that I was trying to explain it, is if you were to redesign the process of delivering a score, would you change the model to start to focus more or less on whatever it is that goes into delivering a FICO score, for instance, or a Vantage score?
Yeah, so I would want to broaden the information to more broadly match what goes into the loan application, not just into the credit score.
Okay. That's from a secondary standpoint, though, right?
Yes.
In terms of the, okay. All right.
Yeah,
Very
now,
good.
let's say on the primary side, Fannie and Freddie can ask for whatever information they want.
Yeah.
Right.
Were you a fan when medical collections were taken out off of mortgage, off credit reports rather? Were you a fan of that? I was one of the few people that said no. Like you would want to know if you were receiving that debt, what the history was. And even though there are, a lot of people have these circumstances where something terrible happens to them, which to me is an outlier. If somebody willingly walks away from an $800 medical bill that they could have paid, right? Or that, to me, this is creating behavior potentially. When that happened, what were your thoughts?
So we've faced similar issues. So like bankruptcies disappear, delinquencies disappear over time. That, I think the investors are fine. Like if there are certain things that are being done for like a societal purpose and it's being done consistently, we'll just deal with it in the pricing.
Right? Oh, it's fine.
It's not like the secondary market needs to make the moral choices for the country, right? That can be made by Congress. And like, even though most people I've spoken to say like, hey, if we can be saving money for the borrowers to originate loans, we're in favor of that. We're happy to facilitate it, but not at the expense of not having information. Or if we have less information, that's fine. We'll just adjust our pricing and you're not going to get the advantage you were hoping for. And so I guess I share basically that view on the medical debt that, it affects everything. There's definitely problems with medical debt. And, we should probably be trying to solve the medical debt problem rather than having it included or not included on our credit reports.
One of the arguments the MBA has been outspoken about when it comes to single pools, they say that single pool has been used effectively in many facets of financial industries, car loans, credit cards. Now, when I look on the outside looking in, and perhaps it's just the environment that we're in because everything's cyclical, right? I look at auto loan delinquencies going up. I look at credit card delinquencies going up, and I think, wow, is that really the example that we should be looking at? It's probably a timing thing. I don't know, but is that a legitimate argument in your eyes?
Yeah, I think it really gets back to something we talked about at the very beginning. So if all of a sudden we decided every mortgage was just going to get a pull from Credit Bureau A, and so there was no gaming possible, there's no adverse selection, that would reduce the quality of the information and would make things worse. And in those other markets, like if it's your bank deciding if they're going to make a loan to you, they choose which credit bureau to use, and they only use one. They don't say, oh yeah, let me look around to see which was your highest score among the three bureaus, and that's how I'll make my lending decision. So it's not really a fair comparison to talk about a system where there's choice and the information going to other people who are bearing the risk, and then the choice being made by the person who's bearing the risk. So it's just not a fair comparison.
What is an underlying or off in the distance danger that you feel like the mortgage industry is not paying close enough attention to right now?
Some people are and some aren't. The thing we've been very focused on is the homeowners insurance side of the equation. And I just saw a paper related to this issue, which said that the amount that people pay for their homeowners insurance is affected by their credit score, whether there's an insurance score. And so we have like a doubling of impact of credit score as well. But insurance rates are rising. That leads to delinquency. The people who have lower credit score are facing larger increases. And so that has a compounding effect as well. I know we're not allowed to talk about climate, but we can talk about insurance, and insurance costs are definitely rising.
You can talk about anything you want on one-on-one.
Obviously,
Well,
we talk about
yeah,
climate when we need to, because
yeah. Now,
it's a
what
real
is?
risk. So.
Do you have any solves for the insurance issue? I mean, do you think the government should step in again? I know people have very strong opinions. Should there be a FEMA like entity, or I guess there's been talk about the people that are paying on time subsidizing the people that aren't. I don't know. Like, do you have a solution in mind?
Yeah. So, there could be a government solution, which seems, unlikely at this point in time. But the real gap comes in is that homeowners insurance resets every year, and your mortgage is for a long time period.
Right.
And
Yeah.
so people think they're getting a fixed rate loan and that they've stabilized their home ownership costs. But now they have a significant cost that can increase each year, and they may not be prepared for that. And so what would be great is if the homeowners insurance industry could get together with the mortgage industry and figure out a way of making the contract a longer contract, or with some protection against increases over time, because that would really benefit both people. We have like a hot potato that's getting thrown back and forth, between two different groups, rather than working together on, solving that problem.
I'm guessing a not too distant second place among the things that we should be thinking of, which is closely associated to a labor of love that you have, is the financial literacy gap. The fact that our children, by and large, are not really smart when it comes to managing money. We're not teaching them the right things. The average age of the home buyer out there has gone up 10 years in the last handful of years. Something you're very passionate about through your nonprofit, FiCycle.org. I want to give you a couple of minutes to opine on this endeavor and what it means to you.
Thanks. I appreciate that opportunity. Yeah. So, as someone who's been involved in like the mortgage market for a long time, I've, seen, people being affected by not making good financial decisions. And also a lot of people come to me and say, oh, what should I do? Are home prices going up or down? Or should I buy this stock that my uncle recommended? Or which Bitcoin do you recommend? And I find very few people have been given the framework to think long-term about their financial decision-making, their financial life. And so what we've done is put together material, mostly at the high school level, that looks at the financial life cycle, which is where the name FiCycle comes from, and combines math and personal finance, and focuses on the ideas of wealth, building wealth, transferring that wealth of consumption through time, measuring risk, and measuring value or return, and giving people the tools they need to make good financial decisions. Credit score is an important part of that as well. There's a lot of misleading information about credit scores and how it affects people. And so we think the more people can start focusing on, what really makes a difference in their life long-term, they can make better financial decisions rather than just focus on strategy or tactics right now. Yeah, thanks for scrolling through this. But you can reach us at FiCycle.org. The other thing we've done recently is introduce something we're calling our Financial Careers Advisory Council. And what we're doing is having people who have jobs in the financial industry, especially those who use mathematics, to come in and talk to the teachers and the students in our classrooms about how they use math day to day. And it makes everything they're learning in class more real. You don't really believe your teacher when they say this is real life. But, when someone from the outside comes in and said, yeah, I actually do double entry bookkeeping. I actually do taxes. We actually compute mortgage rates, makes everything real and gets the students even more engaged.
How often do you think about numbers?
When I went to college, I was a math major, and we didn't use any numbers in math in college. It was all letters and concepts. Here in the mortgage world, it's all numbers. So I try and live in both worlds. Like I'm actually more of like a conceptual thinker than like a numbers guy, but I'm always thinking about the relationship between different aspects and how they're related, and numbers may be a part of that.
I bet you probably were pretty good with the Rubik's Cube at a young age.
I did solve it, yes.
Yeah. How old were you when you solved the Rubik's Cube?
It came out when I was in college, and I solved it before, like,
Oh,
you could go online and get a solution.
you had it done. Well, this is great. And ironically, let me stop sharing my screen here. You and I are going to be sharing a stage
Yeah, I'm
coming
looking
up.
forward to that. It's going to be
Yeah,
fun.
yeah. Housing Wire at the gathering. We'll be on a panel that Zactus is going to help run, and we'll be up there with a couple of other really well-respected industry folks. And I look forward to being up there with the likes of Andy Davidson, president at Andrew Davidson and Company. We covered a lot of ground.
Yep. I'm really looking forward to that panel. I think we can really delve into this. I think having broad discussions with many market participants is like the secret to solving this. We can't all just talk in our own silos.
Yeah, I concur with that. Have a great week and look forward to seeing you soon, Andy. Thank you
Great. Thank you
for
so much.
joining me on One-on-One.
Yeah, take care.